When traders panic,
You going to talk about your sponsor?
we don't panic.
So we don't panic. Neither does the SIBO, which is sponsored by the SIBO.
Always open every day, every morning for us. They wait for us.
More on.
We wait for them.
More on than off usually.
Yes.
Definitely more ons.
So we're talking about IVR and volume here. When fear spikes, traders show up. Then when traders get nervous, they hedge, and that panic shows up as higher volume and higher IVR. You typically, never sell a dull market is kind of the opposite of this statement, in that, when things are just grinding higher, it's usually low volume, low implied volatility. When things are moving, you typically see higher volume, higher implied volatility. That typically happens on downside moves. So we're not saying anything profound here, but there is a twist. Once everyone's in the trade, there's no one left to panic, and volatility fades. Typically, when you have the huge spikes in implied volatility or bigger spikes in implied volatility, it usually marks a bottom. The fear is usually overstated. This study digs into how IVR and trading volume interact in SPY and what happens next. So the question is, when volatility spikes, does the crowd's participation, as measured by volume, help predict how fast volatility will cool off? What do you think, sir?
When volatility spikes, does the crowd participation volume help predict how fast volatility will cool off? How fast? I don't know how they quantify it, but yes, it will predict, but I don't know how they quantify it.
Like spike in vol and spike in volume together. Mm-hmm. Is that the indicator for more to come or bottom?
No, it's usually a capitulation moment in my eyes, up or down. Matter of fact, that's why I talked about it with Bitcoin the other day, and that's why I talked about it with gold. Now, Bitcoin worked, gold didn't.
Yeah.
So,
But that's the trader in you. Most people, the texts you get, like when my sister texts me, it's usually at this point when volumes are really high and volatility is really high. Yeah. I'm losing so much today. Should I sell? That's the moment. Not everybody thinks on the contrarian realm like us and our viewers do. So it might be an easy answer for us to answer.
Yes.
It's not something.
We'll come up with an opinion, right?
Yes. Mm-hmm. So let's get back into the slides here. So the study that we're going to look at is SPY over the last 5 years. So we use IVR and volume. We're looking at the IV decay, which we are defining as the next day IV change split. So this is a percentage by IVR and volume. So you're looking at the IV decay versus IVR and volume. So we're showing really the same story here, how crowd behavior drives the volatility cycle. So volatility compounds on itself as people begin to sell, which is very, very intuitive. So looking at the next slide here, so we're looking at IVR versus volume here. So on the bottom, you'll see implied volatility ranks. This is IVR. And then the volume on the left side here, you can see shows IVR is a reflection of volume and vice versa. And this is intuitive because you typically have the most volume when things are going crazy. You have the most volatility when things are going crazy. They go hand in hand together. And you could see that most of the time when you're in these low volatility regimes, your volume is also low. It's just kind of, by the dip slightly. And then when things get crazy, you see volatility come in, and that's, a reflection of markets.
I have no idea what that scatter plot is showing me.
High implied volatility.
Yes.
So you have IVR of 100. You have lots of volume.
Oh, okay. I got you.
When volume is low, you typically see low implied volatility. Yeah, that's most of the time.
I like it now. Thank you for explaining it to me. To me, with my eyes, it just looked like...
It's good that they put the slide together for you, because you could just take this and print this one out. You don't even need the scatter plot.
This is perfect.
This is the Cliff Notes.
All right, good. I like it.
So each dot represents a trading day for SPY over the last 5 years, showing its IVR and the total trading volume. There's a clear upward slope. You saw how the volume went up, as implied volatility went up as well. Higher IVR equals higher volume. This means when volatility spikes, more traders rush in, typically of fear, which is typical of fear environments. Volume acts as confirmation. It validates that volatility spikes are emotionally charged and not random. It goes hand in hand. Volatility comes in, you see volumes also spike as well. The key takeaways here is high IVR days attract crowded trading, and you can watch for those overreactions. Volume confirms fear. So spikes with high volume are genuine volatility events. A lot of times you'll see downside moves where volume isn't that pronounced or volatility doesn't spike. That's not really like our bottom signals, really. As traders flood in, volatility often peaks, setting up short vol opportunities. We talked about that last week with our VVIX study. You typically get to the kind of the sweet spot where vol's high, and we're talking about volume here. We're putting that part of the story into it. But when vol's high and volatility is high, not extremes, but high, that's what we're targeting. And it goes to everything we talk about with high implied volatility and IVR. You want vol high if you're selling risk.
Certainly do by the trades you were able to peel off today. So yeah,
Yes.
100%. You want vol high.
When IVR is high, but volume is low, the spike may be weak or unconfirmed. It's all the kind of same story here. This next one's really going to get, this next slide's confusing to us laymen's. This is a research team slide.
This research team, you in the know? The heat map.
But we luckily have another Cliff Notes slide for this. So this heat map shows how the next day IV change depends on IVR and volume level. So you're going to be able to see here that the IV increases are sustained when volume is higher. And so getting to the next slide here. So then this slide, the heat map, shows how next day IV changes depending on IVR and volume levels. So the darker colors represent IV increases or small moves. The bright, warmer cells show large IV decays. So the bottom right cell, which is high IVR and high volume, has the most negative IV change. And so when you have high IVR and high volume, you have the highest propensity to have a big implied volatility change. That's what it's saying. When you have low volatility and low volume, you don't typically see volatility change, which is, intuitive. In calm markets, low IVR, volatility doesn't change that much, no matter how much volume comes in. So volume and high volume, high implied volatility is the target here, which is a small amount of those occurrences. The pattern is consistent, though. Fear peaks with high volume and then fades fastest afterwards. So you get these spikes in implied volatility. It tends to be the biggest moves in terms of IV crush after a spike. You don't typically see big moves in implied volatility, big crushes in implied volatility when volatility is low. So the key takeaways here, high IVR.
What do we play for? I mean, we play for volatility contraction, not only price, we play for volatility contraction. So
Yes.
again, another reason why you want to do this when volatility is high. If you didn't get a chance to do that, you almost lost your volatility today with it down full of, what is it?
The volatility contraction now comes in 24 to 48 hours.
Yes.
That's all you get. There was once upon a time where you'd have a little bit of volatility, like sustained.
You'd have weeks sometimes.
You'd have a week or 2 weeks. Not anymore.
No.
So the key takeaways here, high IVR and high volume equals the juiciest short vol setups. Elevated IV with heavy trading activity leads to mean reversion the next day. After the study is the last 5 years. So the next day you're getting vol crush after these spikes. Pretty wild. Low IVR equals quiet markets. Selling vol offers little reward. I mean, that's why we target high IVR, is because you get paid to put that risk on. And in the last couple of years, it's been very, very quick that you've got paid on that risk.
Right.
When both metrics spike, expect a volatility crush as traders unwind hedges. This is another reflection of when volatility gets high, people rush to get protection, which means they pay up for that protection into lower prices. And when it doesn't realize that move, those options move very, very quickly, and you have a propensity to take off those hedges, which is another natural bid. So you get kind of this, the volatility of the actual price move is big in both directions when you have high implied volatility.
Very nice. Very good.
Last slide here. So the final takeaways here. Fear fuels trading when markets get scared. Both volatility, which we look at as IVR here, and trading volumes rise. Crowd peaks mean reversal. Once everyone reacts, there's no one left to panic. Volatility fades. So typically, those spikes in vol are usually your signal to get some long delta there, or at least sell some volatility. Volume confirms fear. So high IVR and high volume signals real emotional driven volatility. So you typically have those two go hand in hand. High IVR and high volume is our short vol setup. I mean, this is what we look for in all of our trading here. Call markets, you got low reward. Low IVR means little movement. At least that's what the market's pricing in. So you might have to be a little bit more directional versus the short volatility aspect of the trade.